Thank you all for coming, and I wanted to start by acknowledging my co-author, Kathleen Hanley, who is also here. I also wanted to note that we think this paper is a perfect follow-on to the presentation that we just saw. To put it in perspective, we're also using text mining. We're also thinking about dynamic models of systemic risk here. Just to compare, to give you a sense of where I'm going, is the presentation we just saw really is about transmission potential of a systemic event, right? How is it going to go through the network? How fast? When we think about dynamic risk in our setting, we're really thinking about detecting the presence of a systemic event that might transmit through the network that you just saw. So we're looking at detection of event rather than transmission. We also wanted to thank the National Science Foundation as well as the OFR for funding this research. Couldn't be possible without it. And let me just go very quickly through some of the theoretical framework that we have in mind for this project. So we're interested in information production in the banking sector. We're thinking about, for example, the Big Short, that there might be people out there acting on systemic risk information production. There's information coming from the banks and required disclosure. Can we put them together and actually detect the presence of systemic risk building? Now, when we look at theories directly related to the point, Bengt Holström, his comments yesterday is that, hey, this is a very opaque industry. We should not expect this to be an easy task. And that is really brought out by some very rigorous theory that it should be very difficult to detect this information. So what I want to do is give you a quick theoretical snapshot of what we have in mind, why we think this problem is in fact tractable, is that if you look at the world as having three states, first, no crisis, followed by a transition period, which is absolutely critical in our setting, where you're going from no information production, not all the way to panic immediately. That is, there's some frictions in the economy where this process is slow. People start building information. That gives us the central premise that really guides our work, is that during this transition period, those who are producing information will take actions. And can we see their actions in big data? So we talked about some of the ideal properties of a systemic risk model. And again, in the paper, we provide a lot more details. But what we really want to have in mind is that the researcher who's looking for the rise of systemic risk, we don't want their opinions to be weighted too heavily. They may be backward looking. Crisis may have another problem that's really driving what you actually observe. We also want a model that can detect risks dynamically. That is, we don't want to use data that's too stale. We want to keep running the model to see when things are suddenly changing. And finally, where we think our work is most central is we want to focus on the ability to interpret, not only that we see changes in the way stocks are being traded, the rise of systemic risk, but can we use the natural language processing, the text itself, to reveal the channels that are actually driving the trading. And that's really where I think it's the core of what we're doing. So I have so little time and so much to say about methods, so I'm just going to give you the 40,000-foot view here, is that what we're doing here is we're taking risk factor section of the 10K. So we observe this every year, so it is a frequently disclosed document. We're parsing out the risk factor just of US publicly traded banks. And then, okay, if you read the paper, you'll see all the details. But the bottom line is we are converting this data structure, which is free form, basically into a factor model. That is, what are the risks that are systematically present in many banks? So we use specifically methodologies in text mining that are all about capturing what's systemically present, not something that only one bank discloses. In going through this process, we want to improve the interpretability. So not only can we show you that there's a risk that's present, but we want to put a distinctive label on it. So when you see that trading is elevated at a particular time, we can point to, hey, it's capital requirements risk, or what we have here is interest rate risk. So what we find is that there are 18 distinctive themes that are measurable. And at the end of the day, when you follow the methodology, here is the result. So you're going to see this database really manifesting in everything I'm about to show you, is we create a database that's once per bank in each year. It's updated every year. And for each bank in each year, we have how much of each of the semantic themes your disclosure is discussing. We have the intensity. The idea is that that's an exposure to risk. So just briefly, one of the bigger innovations in the study, and really why the NSF funding was very critical, is that we don't know of any other studies in finance that really use semantic analysis, which is really a more recent technology. You can see the vintage. Okay, and this paper here was cited in Google Scholar 4,000 times already in just a couple of years. See how it's really rising in prominence in computer science. But we're not aware of other papers that use this technology. And the key thing here is interpretability of what's driving the changes in the covariance matrix we're going to show you. This is what semantic analysis looks like, is that it derives, if you give it capital requirements, you want to say, what does capital requirements look like in the disclosure? It detects all of the vocabulary that generally would appear around that phrase, and that's sort of what you can use to actually score documents. So long and short, data is otherwise standard. Okay, we are using call reports to control for non-text variables. We're looking at FDIC failures, but the key thing here is using the 10Ks is what's novel. So now let me get into the econometrics. Okay, so what we want to do is we want to detect activities in actual public trading of equities that indicates the potential rise of systemic risk. So we also want it to be dynamic. So note the subscripts. We're going to take the covariance of two banks, I and J. There's a lot of observations here because covariance goes with n squared. Okay, we have a lot of covariance data. And in every quarter T, we want to say, look, how much of the covariance is explainable through either X, which would be a vector of controls, things we've seen in the call reports, but in the extended model, critically, we want to say how much of the covariance between a pair of banks is explained by the themes. The S here, this is common exposures to the 18 themes that I showed you from the 10K. If the answer is a lot of R squared, okay, think about Richard Roll's work on R squared, it would indicate that a lot of trading activity is related to things that are candidate systemic risks, and that could be a warning bell. So let me show you the results, and then I'll go down and drill down and show you what the semantics can tell us. The main result of the paper is that in quiet times, the R squared is low. And that's really what the theory would predict. A lot of Gary Gorton's work is that there's not a lot of information production. There's no incentive in good times. But as we roll forward to 2004, 2005, the risk factor text is starting to explain a lot of the covariance. And this here is a T statistic. And it starts to jump above levels of 3, 4, 5 already by early 2005. So in other words, we really saw a lot of the systemic activity in 2008. But we're seeing that the transition period that I alluded to might be as long as 3 years. The second major result in the paper is what you're seeing at the right end, is that suddenly when we go to 2015, 2014, right now, okay, the model is saying there's a lot of systemic trading going on. So what I want to do next is show you that, hey, we can use the natural language processing not only to show you that the R squared is high, but to say, what are those risks? We can decompose the R squared. What are the risks that are elevated at any point in time? So of the 18 risks, we see that 8 of them are elevated prior to the crisis of 2008. Notice the headers here are the semantic themes that identify what kind of risk it is. Not only do we show you intensity, which here is a T statistic, some of these are very large, but you can see the ordering. So systemic trading as early as 2004, explaining covariance of banks related to marketable securities is one of the first, if you will, elevated risks that we see here. You want to think about marketable securities, commercial paper, possibly mortgage-backed securities. And second, we see a prolonged and very intense rise of real estate risk. And also we see exposure of the risk management discussion that the bank has as well. Interestingly, later we see rating agencies. So what I want to say is that this is really, if you will, the first test of the model to say, does this ring true in terms of what we observed in 2008? And we think a lot of the themes here make a lot of sense. But now the second question is, well, why is there a lot of systemic risk trading now? The model is meant to be dynamic. It's meant to tell you what people are trading on, even if you as an economist do not have a strong prior belief about what's going on in the economy. So what you're seeing here now is we identified these risk factors as being elevated now on the right-hand side. In other words, they're explaining a lot of the R squared right now. And some of the more noteworthy ones with the highest, if you will, T statistic are particularly funding sources. So funding sources of banks, people may be worried about that particular issue going forward. Also, we see regulation risk has become very high, more so than it was in the previous episode of uncertainty, as well as capital requirements also seems to be something that's very relevant right now. In the paper, we go into this in a lot more detail. I don't have time to discuss this more right now. So in the spirit of time, I want to show you one other very important test that we look at. So everything I've done up until this point is time series. We're showing you what is elevated at any particular time. Now I'm going to pivot and say, let's ask the cross-sectional question. Can we actually triage which banks are most exposed to the systemic trading? What we do is we take the covariance model, we use a predicted value, and then we aggregate it at the bank level, and that can tell us which are most exposed, giving us a cross-sectional variable that we call number of emerging factors. Now what I'm doing is I'm running a single cross-sectional regression predicting the stock returns during the crisis, and I'm saying if I use old data, if I use data from the model from 2006, am I able to predict a negative outcome, which banks are having negative returns? And the answer turns out to be the case that the model can predict the winner and loser banks pretty well starting in 2006 and forward. And now what I want to show you is how about in the recent episode of market instability. This is a time when banks overall had a minus 20% return relative to the S&P 500. Our model was predicting which banks had a bad return during that particular episode all the way back as far as 2011. Etc. And it relates to those factors that I showed you a few slides back as the ones that are actually driving the trading. Now I just want to show you one last cross-sectional regression. Is now we're using FDIC data and we're looking at actual bank failures. So how early does our emerging risk model predict which banks will actually fail following the Lehman crisis? And what we're seeing here is that the positive coefficients of emerging risk means you are positively predicting the failures, the losers. And the model actually does even better, in a sense, at predicting which banks fail, because now we're seeing 2005. The model already was sorting. Those most exposed to the risks that I showed you are the ones that more likely actually failed. And you see very high T statistics in certain periods. So these results are really consistent with detecting information in the covariance matrix indicating that there is trading activity. It's a big database, so there's ample power to actually detect these types of outcomes. So I think I only have about 1 minute left, so let me actually move on to conclusions. So we propose a dynamic model of emerging systemic risks. And it's really based on the information production models that you see out there. We're thinking about Gorton, Ordonez, Holstrom have models of this sort. But we want to think about there being a transition period that lasts maybe about 3 years due to potential frictions in the market. Now, benefits and results is that as the theory would predict, we have no results in quiet times. And that's a wonderful benchmark. But we see elevation close to the crisis, and we see elevation in more recent times. But relative to other work in the area, we think this paper is particularly, if you will, distinct in the sense is that we're actually using the natural language processing. This is the real key contribution of the paper to interpret channels. So not only is there an elevated risk, but we can tell you what's actually driving it. So anyway, in the long term, we think the possibility of an early warning system is possible through this kind of modeling. And also, our results really, they show that all of the risk factor disclosure that the SEC has been doing for decades actually has value. And a priori, a lot of people may not have thought that the risk factor disclosure was very valuable. But in this setting, it's quite interesting. Thank you.
Okay, well, thank you very much, firstly, for the invitation to speak here today. I should say that this is co-authored work with Rickard, Nyman, Paul Ormerod, David Tuckett, and Rob Smith from UCL, as well as with David Gregory. And what I say today obviously represents my own views and not those of the Bank of England. So this paper is also going to be about using text-based analysis to gauge systemic risk in financial systems. So some similarities with the previous talk, but from a slightly different perspective. But let me just start by explaining why we pursued the research, what the motivation was it that led us to go down this line. 3 broad areas. Firstly, from a policy perspective, we're very interested in wanting to know when to deploy time-varying macroprudential policies. So in the UK, we have the Bank of England has control over the countercyclical capital buffer. But to be able to use that, we need to be able to identify emerging risks in the financial system sufficiently well in advance to be able to take preemptive action. Now, we have a bunch of information we look at, leading indicators, credit information, and so on. But one of the things we're interested in is, through a lot of our work, we look at market intelligence, qualitative information to identify emerging risks in the financial system. But we thought, can we do anything quantitative with the text-based information in the information that we receive through our market intelligence from our markets area? So that was the kind of policy motivation. From a theoretical perspective, there's obviously a long trend in economics from emphasizing the role of sentiment, emotions, narratives in driving economic and financial behavior, going back to Keynes's description of animal spirits in the 1930s. But most recently, Bob Shiller's done a lot of work talking about the role of narratives in driving decision making. And that's had recent grounding in psychology, where my co-author and some others have discussed how agents act through the use of narratives, and that these narratives must have emotional support. So when people take decisions, they must be sufficiently excited about the opportunity for gain, and they must have suppressed fears of anxiety, fears of doubt about losses. These narratives can spread systemically through social networks, through media, and precipitate consensus. So this is the idea that there can be a new hot thing that comes along, whether it's subprime mortgages, dot-com stocks, sovereign debt, or so on, and that when people have those narratives, they think that's the best thing going. Finally, there's a large empirical literature using text-based analysis linked to sentiment, typically with different applications, but we're also drawing on that literature. So what are we going to do? We're going to exploit a big data approach to investigate essentially the effect of narratives on the financial system. And what we're going to try to do is get a quantitative lens on market news and intelligence, in particular through 2 key questions that we're going to try and answer. Can text-based measures of shifts in the balance between excitement and anxiety be useful as a leading indicator? And can we also gauge the extent of consensus over different narratives in the information that we see, and can that be also used as additional information? The punchline is that what we find is that we find evidence of increasing consensus over narratives which were very high in excitement and lacking in anxiety prior to the crisis, which then evaporated during the crisis, and that these indicators that we developed seem to have promise, both at a low frequency in terms of identifying emerging systemic risk, and at a higher frequency in terms of relationships with other commonly used measures of volatility and sentiment. So key contributions: theoretical filter to our text-based analysis, a focus on systemic risk, and we're using particular financial system data sources which are quite novel, including an internal source. So the data we've got 3 sources. The first one is that every day on my email account I get 3 or 4 emails from my markets area, snap updates on the state of markets. We have those emails back to 2000, and these are going to be essentially the market commentary. They're commentaries, snap commentaries on the markets, written internally. Second source is broker circulars. Got a shorter sample there. Third source is going to be Reuters News Archive, Wired stories all the way back to the mid-90s. So every story published in London, with some exclusions, like stories about sport and weather, for example, which is quite popular in England. So what the methodology is to capture sentiment. So we've got theoretically motivated and validated words dictionaries. There's approximately about 150 words in each dictionary. You've got samples of the positive words and the negative words here. They are all ordinary English words. And we wanted to do that because we think that's more robust in terms of thinking about wider different sources, and it's more effective at trying to gauge sentiment in terms of the content of the ways in which people are writing. The metric is very simple. It's the number of excitement words minus the number of anxiety words normalized by the number of characters in the document. So we're trying to look at how excited or anxious the content of the documents are that we are analyzing. It's very simple. There's no machine learning, no complex techniques going on. We think that makes it more robust. Arguably, it obviously makes it more transparent to see what is going on. So what does it look like? This chart is for these are the emails that I described, the internal emails back to 2000. And what you can see is quite a striking pattern. Elevated sentiment, persistent between about 2004 and 2007, which then starts to dip actually well before the worst of the crisis at Lehman Brothers. It's pretty indicative of the potential power of the measure just from the events. What we also did is we ran a bunch of structural break tests on the series as well. And what you see, these are the red dotted lines, we actually identify structural breaks. 2 positive ones in mid-2003 and late 2004. The negative one is in December 2007. This shows, I think, hopefully the potential at a low frequency of this sort of metric for gauging systemic risk. You can decompose that into excitement and anxiety, which what we've done in this chart. What's interesting is that it's the removal of anxiety from the way in which people are viewing the system that is driving much of the movements in this chart. So people are suppressing their fears, suppressing concerns about negative outcomes. That's kind of consistent with a heuristic-based approach towards Knightian uncertainty. Just to show you very quickly, I mean, the paper has a lot more on this. Here are the other 3 measures. They're all reasonably correlated, and you can see that they kind of move as you might expect with relation to recent events. So, here's another one. Whatever it takes, Draghi's speech in 2012. Again, you see a sharp increase in sentiment following that sort of speech, which was meant to be a confidence-type speech. So how does this compare with other metrics? This is pretty striking. It is going back to our market commentary statistic. I'm just plotting it against the VIX. And what is very striking is that, again, you see a very striking correlation. You see that at low frequency, both of these measures are picking up things well before the crisis. But this sort of chart also leads one to think, can at a higher frequency these measures have predictive power for things like the VIX, other commonly used measures of sentiment? So what we did, I'm not sure what's gone on with this chart, but if you ignore the question marks, for which apologies, these are correlation. It's a correlation analysis of our 3 measures against the VIX, the Michigan, Baker-Bloom's Uncertainty Index, a Bank of England one that's quite similar, CDS and PMI, which is like a UK version of the Michigan. What you find that all these are normal, all have the expected sign, so these are absolute correlations. At time t, you see quite high correlations. If we lag our own variables, we see typically even higher correlations 1 period ahead, which is suggestive that our indicators are both useful because they seem to correlate quite well with this wide set of measures, but also that they might have useful leading predictive information. So I thought this would be messed up. We ran a bunch of Granger causality tests as well to see if that was likely to be the case. What you find here, the stars represent where the Granger causality test is significant, that the Reuters series, for which we have the most data, so therefore we have the most power in our test, is predictive in a Granger causality sense of a bunch of these measures pretty robustly. The markets one is doing quite well on the ones that relate more to financial markets. So it's doing quite well in relation to the VIX, and the UK policy uncertainty measure. Broker Circulars does quite well in relation to the Michigan. So again, we find some good evidence of or indicative evidence that these measures are useful. I should also say we tried the Granger causality test in the reverse direction, and we didn't find much evidence of reverse Granger causality from the VIX and the EPU and so on back to the measures that we find. So some suggestion of leading information. What are these measures? Might have an impact on the wider economy. So what we did there is we tried to put these through a simple VAR model of the UK economy with a standard set of variables. And just try to analyse, do these measures seem to have some information for the macroeconomy? What the right-hand chart shows here is the impulse response from sentiment, the measure we have, to GDP. So it's not significant, but we are finding sort of a correct sign. The left-hand chart just uses another uncertainty measure, the one we have in the Bank of England, which we do use as a leading indicator on GDP because it does have some useful properties. What we then did is actually try and see if our own measure predicts the uncertainty measure, which then goes on to predict GDP. What we're finding is that our measure in this VAR context seems to have information for the economic policy uncertainty measure that we're using internally at the bank. That policy uncertainty measure is then leading on to GDP. So it seems like anxiety is perhaps showing up in our text-based measures. That is then reflected in uncertainty that you see in the uncertainty measures, and then that is having an impact on growth. So it has through this sort of analysis, we can see that this sort of measure and this sort of approach might have real potential for actually trying to think about future economic developments. Second exercise, which I'll talk about much more briefly, we try to also measure consensus across these narratives. And what we want to do is we want to try and measure two things. We want to know the number of narratives at a given moment, how many different stories there are about, say, the UK housing market or sovereign debt in Europe, and the size of each narrative, so how important is each one. To do this, we analyse the entropy of the distribution of topics, because as entropy is essentially a measure of the dispersion. So when entropy falls, when the size of each, the number of narratives grows, entropy falls. When the size of each narrative grows, entropy increases. So essentially, this entropy measure captures both the number and the size of narratives in a simple summary statistic. To develop the measure, what we do is we basically use this is actually now a machine learning approach where we cluster all of the different documents into a distinct set of components where each of the components is identified with a particular topic. So you might get, for example, 100 articles about sovereign debt, 300 about oil. And then we measure the entropy or the dispersion across those clusters. What does it look like? So here what I've done is I've plotted the Reuters. This is now one of the Reuters series because we need a lot of data to do this. So the Reuters is the series you've already seen, which is the grey. So when entropy falls, consensus is going up. So what you find here is this is the yellow line. Consensus is also increasing sharply between 2005 and 6. And then there's a lot of disagreement coming in after that. When we look at the documents, what we find here is essentially quite a buoyant sense about the state of markets, and then disagreement coming about, a lot of uncertainty about weak credit conditions in Europe, and so on coming in here. But the bottom line here is that at a time when sentiment is very high, there's a lot of consensus about it. And perhaps that's the time when we should be most worried, when everyone agrees that the things are really good and everyone's really excited. So the combination of these things could add a lot of value. Maybe I just thought I'd pick up one of Bob Shiller's quotes in this space. It is important to say this obviously reflects the news content. So we're not explicitly modeling here market consensus, but as Bob Shiller's talks about a lot, the way in which people might behave might be reflected by things in the media, what people are writing, and therefore these two things might go quite hand in hand. So to summarize, what we've done here is hopefully try to show you that we've come up with various measures of sentiment using text-based information and use that to identify consensus over narratives in a range of financial market data sources. And I think what's quite interesting, I think I've been quite struck by, is that these measures seem to have use at both a high frequency and at a low frequency. So at a low frequency, we seem to identify long periods where the measures are quite stable and quite excited, or perhaps after the crisis where you're showing quite a lot of bad sentiment and they're quite volatile. And yet also at a high frequency, they seem to be predictive, or according to a Granger causality test and VAR type models, predictive of other measures of sentiment that are commonly used and are commonly regarded as important in the system. So that shows, I think, a lot of power in this approach. Now, we clearly need to do a lot of work refining these sorts of measures, but I think this hopefully shows the potential and the promise of using these sorts of methods for systemic risk assessment. The other thing I think hopefully this is emphasised is that this is quite a simple method, and the words, as I've said, are drawn from a theoretical filter. Again, I think that makes it quite valuable because the results are pretty robust across different samples. So just in terms of further work, trying to develop sentiment series further, a bunch of different macroeconomic applications. But the last thing I just wanted to say is that we've got a big research agenda at the Bank of England, and big data is right at the centre of this. We're doing a bunch of other work using text-based analysis. So for example, we've analysed the tweets around the Scottish referendum and published that on our blog. We've got a bunch of other text-based mining projects looking at supervisory letters, looking at, for example, online vacancy postings to identify developments in the job market. We think this sort of method has a lot of power across a whole range of economic and financial topics. So thanks very much.
All right. Thank you very much for having me and for having the paper on the program. This is joint work with Silvia Gabrieli, and since I'm at Bundesbank, for both of us the usual disclaimer applies. what we do is slightly different from the two papers previously in this session. They're much more related to what we had for lunch. We take a very detailed view at interconnectedness in the euro area interbank market. So we do a lot of analysis, but in the end we end up with a very clinical study of the interbank market around the time of the Lehman insolvency. And just for a US audience, it's useful to motivate this. Interbank markets in Europe are very different from the US equivalent. In Europe, they are the major source of liquidity for banks. In Germany, the average size of the interbank market as a percentage of the bank's balance sheet is between 25 and 30%. So and that's both for the asset and the liability side. So since they are the major source of liquidity for euro area bank, a functioning interbank market is absolutely crucial for financial stability. Without a well-functioning interbank market, banks cannot refinance, and they need to liquidate, which can turn illiquidity into insolvency. That's something that we were very afraid of in 2008. On a more fundamental level, we are also interested in the interbank market since it's the first market, first intermediary market in the implementation of monetary policy. Without proper pricing in interbank markets, we cannot signal the monetary policy stance. And therefore, market disruptions in this market can have real economic consequences. What we ask in this paper is, how did the Lehman event affect the unsecured interbank lending in the euro area? And you think you know the answer to that. There's a very simple graph that sort of summarizes the narrative of Lehman and the interbank market. So this is the LIBOR-OIS spread, a measure of riskiness in the interbank market, and it's the TED spread. And the usual story is, since we had this large, unprecedented increase in both spreads, there's probably some market freeze going on. There's probably a shortening of the turnover. There's banks that are being cut off the interbank market. And we try to study this in more detail, and we will actually challenge this common narrative. So this increase in risk premia, they are usually what we take as an indicator of a market freeze. And there are different theories how such a market freeze can happen. It's either because there's counterparty risk, you're not willing to lend to a counterparty anymore, you cut off your lending, or you are afraid that you might be rationed on the interbank market, so you start holding on to your liquidity for precautionary purposes. And the policy remedy to these situations, to these economic problems, are to either provide bank capital to absorb the counterparty risk, or to provide lots of liquidity to take away the fear of running out of liquidity. And this is exactly what happened in 2008. I'll tell you a little bit about the institutional setting as I show you some of the aggregate slides. What we do is we use payment system data from the target to payment system in Europe, which settles more than 90% of all transactions between all European banks. The data is, compared to the data in the US and in the UK, much more granular, because we have information about ultimate originator and beneficiary of the data that allows us to identify interbank loans with an unparalleled precision. So many of the problems that our US colleagues unfortunately have with Fedwire and the Furfine algorithm do not apply in Europe. We did extensive testing with credit registries to actually verify that we do indeed identify interbank loans. And the institutional setting is such that all these interbank loans are unsecured. There are several reasons for that. Most of the secured stuff goes through the Euro 1 payment system. We take away the central counterparty that is usually involved in all the secured stuff that might be left on target too. So we really have a unique, detailed view on unsecured interbank lending in Europe. And the one graph that summarizes, I think, the key policy finding that we study is, just look at the turnover. It's very simple. We look at the turnover, but the addition that we have is, we can't just look at the overnight turnover, which is the light blue graph, but we also have, because we have better information about originator beneficiary, the maturities up to 1 year. And there's quite a bit of activity in the segment of 1 week. There's quite some activity in the segment of loans with a maturity of 1 year. And this is unsecured interbank loans with a maturity of 1 year. So usually the story that you heard about the crisis would be, okay, there's a drop in volume right around the time of the Lehman insolvency, which is this dashed line. But the data does not support this. And there's a paper by Antoinette and co-authors here in the US on the Fed funds market, that it was stressed but not frozen. And we can shed a little bit of light on this because we find something very similar. The market didn't dry up. In fact, the opposite was the case. There was more lending in the interbank market. And the only sign you can find that there were problems is a drop in the volume of the term segment. So what was happening was that banks seemed to pull out of the term lending, pushed things in the overnight segment. But since this is a stacked aggregate chart, you can see that the increase in the overnight was much more than the decrease in the term segment. So this common narrative of a market freeze does not hold. Nonetheless, there were two key events where the Eurosystem intervened. The first is 29 September, we conducted the first special refinancing operation with full allotment. So that was de facto the move to full allotment, which was in our monetary policy operations conducted on 15 October. But from this day onward, the interbank market started to decline. So when you look at the aggregate numbers, end of quarter numbers that we used to have before, you would think, oh, there was a big drop in the interbank market, which in fact comes from the Eurosystem substituting a big chunk of this market, which is still gone. And the discussion about how to restart interbank lending is still ongoing. We also had a look at the pricing to see, okay, maybe there wasn't a big volume effect, but clearly since these indicators jumped up, there must be something in the pricing. So the same chart, same timeline. This is Lehman. Around Lehman, you see some increase in the standard deviation, so some increase in the volatility of pricing, but the price itself on average remained more or less constant. You see that there's, in the dotted red line is not very easy to see, but there's, starting from Lehman, there's a deviation from the Ionia rate from the actual interbank rate, which is this light blue line, which wasn't present before. So there was clearly something where market participants were more afraid because in Ionia you are asked about what do you think you can refinance yourself than what actually happened. Surprisingly, even in the term segment, not a lot of price increase happened. You see the same sort of volatility, you see the same rough average price. So even the 1 year interbank market had a fairly constant price. So we do an econometric exercise to find out what are the economic reasons for price dynamics, what happened exactly after Lehman. We do find some signs of counterparty risk concerns in the overnight segment of the interbank market, but we do find that already 2 weeks before the Lehman event. There's very little that happened in the 2 days afterwards and in the 2 weeks afterwards. But what we find is that after the Lehman event, banks engage in maturity shortening. So they still lend to the same counterparties, but not quite at the same maturities anymore. And this explains why banks at the time of just after Lehman were very concerned. Okay, we see all this maturity evaporate. We see all the liquidity flowing out of our balance sheets. And they were concerned that this might actually happen in the overnight segment, even though once you see the aggregate picture, you know that this doesn't happen. Now, the fact that the aggregate price for liquidity remained constant, roughly constant, after the Lehman effect, masks a large excess and heterogeneity in banks' access to liquidity. On average, and for the standard deviation, not a lot happened. But still, you could see some banks that after the fact, especially in the overnight segment, had trouble accessing the interbank market at the same frequency as they did before. So this heterogeneity is revealed when we study the network structure, and this is where the connection to the lunch talk comes in. When we study the network structure of the interbank market. The interbank market is an over-the-counter, opaque market. Market participants find each other, they trade with one another, but the information about the global structure is not available except to the regulators. So when you do a comparison and just check every link in the 2 weeks before Lehman, the 2 weeks afterwards, every bilateral transaction, did it exist before, did it exist afterwards? We find that half of the lending relationships change in the 2 weeks after the Lehman insolvency. So there was quite a big change, and that's larger than in normal times. Quite a big change in the structure of the interbank network. And what we do in the paper is we ask, okay, what are the consequences of this change? I don't have as nice pictures about the network as we had this for lunch, mainly because of confidentiality constraints. The good thing about having supervisory data is you actually have every single transaction. The bad thing is you can't tell. So we have a stylized picture to give a bit of intuition why the centrality that we heard earlier today already, why that could carry economically meaningful information. So consider two situations. We have two banks sitting here. They have locally the exact same balance sheet. They have some lending and the very boring liability side where they get their loans from two other guys. The only difference between this guy and this guy here is the centrality. It has the same number of local connections, has the same size, the same everything, but if we count the number of shortest paths of liquidity transfer that are possible in the system, and we count on how many of these shortest paths this bank is, we see a difference between the two. And this difference can be measured as centrality, as the betweenness centrality. So there's a lot of theory that says, okay, if we have agents that are more betweenness central, this translates into higher bargaining power. And this is the main hypothesis that we are testing. There's a couple of other things to support this. So what we try to find out is how large is the intermediation spread that banks make after the Lehman insolvency when they experience a shift in their centrality that is not due to a shift in their local neighborhood. So you see a global network structure change, you have the same local neighborhood, and therefore the bank that has an increase in their centrality, not due to their own actions, but due to the action of the network as a whole, we compare this bank with a bank that did not see this change in their centrality. The identification strategy that we use is pretty straightforward. We look at a very stylized bank balance sheet. We take interbank loans from Bank I to Bank J. And then we look at a shock. And so this is a different diff setting where we introduce borrowing bank fixed effects to control for demand, because it could be that Lehman, and in fact, it's reasonable to assume that Lehman affects the borrowers and the lenders somehow equally. So you need to control for changes in demand. We have the change in interbank deposits, and our hypothesis is that this change is somehow proportional to a bank's position, in this case, their centrality. We do a similar thing for the extensive margin. There's a couple of crucial assumptions that go into this. The first is that the shock is unanticipated. For Lehman, you can debate whether or not it was truly unanticipated. Since we are looking at European banks, there was less information and insight into what the Fed would actually do. Would they bail out Lehman? If so, what are the conditions? So this is the part that is easy. The other part is that banks cannot control their centrality. That's a remaining concern. What happens if I think there's a network structure change? I know that having many neighbors, many well-connected neighbors is good for me, so I choose them endogenously. But this only works if you could control all the links in the network, which you can't. You can only control your local neighborhood. So what we do in the paper is we have a couple of robustness checks where we show that there are very mild conditions under which banks indeed cannot control their centrality, simply because it's too sensitive on the network structure as a whole, and therefore too sensitive to decisions outside of what they can do. We find overwhelming support for the main hypothesis that banks which experience a one standard deviation increase in their betweenness centrality make substantial larger intermediation spread. And just to compare these figures, the average intermediation spread before Lehman is roughly 90 basis points in the overnight interbank market. If you see a one standard deviation increase in your network centrality through to this shock, you make a 30 basis points higher intermediation spread afterwards. This is important when you think about models of over-the-counter markets, a la Duffy, Galliano, Pedersen, where you abstract away the structure of the market itself. You have a lot of inventories that you take into account, and you have a lot of different kinds of agents that you take into account. But exactly the network structure of these relations you don't usually take into account. And that's fine if these effects were small. But that's exactly the contribution of the paper, to show they are much larger than you might think initially. And that's in line with experimental evidence on trading in networks. We have a couple of supporting hypotheses that the banks that make a larger intermediation spread actually do intermediate more. They pay a lower spread on their liquidity. And just to wrap up, there are some policy conclusions. The first one, which I can't stress enough, is that the extensive liquidity supply by the Eurosystem did in fact substituted a large chunk of the euro area interbank market, with all the consequences for prices, for efficiency, for market discipline. In the debate about whether or not we do need the interbank market, this is a point that is easily overlooked. But there are substantial effects that come from the change in the structure due to the substitution. The resulting change in the interbank network structure reduced the bargaining power vary between the central banks. And while I'm not saying anything about Deutsche Bank, you can think about a large German bank which was very highly between the central and which has profitability problems. So there's a clear link between being able to extract rents from trading in the interbank market and your position. And if we change this position because of central bank policy, this is one of the unintended consequences. What we do in the paper with one sentence is to relate the global structure of the interbank network with the local liquidity reallocation. And we show that the price that you locally pay for your liquidity depends, among other things, on your position in the interbank network. And with that, I would like to thank you.
Okay, well, I want to start by thanking Debbie Lucas for her leadership in creating this wonderful center that is hosting this event. I also want to thank the co-organizers, Bob Merton and Jonathan Parker, for putting together the program and inviting me to speak. And most of all, I want to thank the donors for making this center possible. We've had a number of very supportive friends of the center. Bernie Horn, I think, is here, who got us started. We got Warren and Mary Naftal, who supported us as well. But recently we got a transformational gift from Ben Golub, which is the reason that we are now called the Golub Center for Finance and Policy. And I want to mention that this is particularly important because, in this season of this very strange presidential election, the whole notion of branding, the power of branding, the terrible power of it, I think has really become clear to all of us. And MIT's got an extraordinary brand in finance, thanks to Bob Merton and many of the other giants that have been here and on whose coattails I and some of my colleagues are riding. And so we are very careful about the MIT Sloan franchise. There are very few names that we want to have associated with the Center for Finance and Policy. And I speak for all my finance colleagues to say that, Ben, we're honored to have your name associated with our effort. So thank you for supporting us. What I want to do today is to try to put things in context by talking a bit about the theme of the conference, which is what do we know now that the dust has settled? I'm not really sure that the dust is completely settled. Maybe there's new dust coming up, but at least it gives us a chance to sort of reflect. And in particular, since the focus in this session is on systemic risk, I want to talk a bit about the dust settling in that respect. So let's talk about a comparison of where things were when the dust hadn't settled versus now. And to do that, I'm just going to put up a few statistics that I'm sure many of you are familiar with. July 2009, unemployment was 9.5%. We're now half of that. GDP growth was -1%. We're now at a little bit more than 1%. Housing starts were a little bit more than 500,000. We're now over 1 million. Inflation at -1% back then. Now it's at +1%. And of course, the Fed balance sheet was only $2 trillion now. Now it's a little over $4 trillion. Lots of change and lots of progress. What about systemic risk? What was systemic risk back then in 2009? What is it now? We don't know, which is kind of astonishing, isn't it? Given that that's one of the central issues about the financial crisis. That almost a decade later, we still don't have a measure of where we are, where we've been, and where we're likely to go. So, that's really the nature of the macroprudential policy intervention exercise. You can't intervene unless you have a reason. You can't manage what you don't measure. And I think it's fair to say that any kind of risk management policy, whether we're talking about microprudential or macroprudential, it involves some form of pain. The pain of raising capital, reducing leverage, cutting exposures, putting a hedge on, buying insurance, shutting down or cutting back on a business. That's painful if the business is going well. And yet that's what we're talking about when we're talking about risk management at the firm level or at the systemic level. And so the question is, how do we do that? How do we take resources away from a currently profitable and otherwise very pleasant activity? And the answer is that it's hard. It requires a new narrative. It requires something different from what you're doing. And we're very fortunate here today to have two individuals that are in the midst of it. Nellie Liang, our moderator, is as the head of financial stability at the Fed. She's the closest thing we have to a chief risk officer for the banking system. And Ben, as the chief risk officer of one of the largest asset management companies, he is responsible for managing the risk of those two firms. So I want to use them as examples and ask the question, what does it take to motivate Nellie or Ben to go to their superiors and say, you know what, it's time to cut back on risk. It's time to raise capital. It's time to intervene. It's time to stop doing what we're doing now. What does it take for them to do that? And so I want to give you a little bit of an analogy. I don't know how many of you have ever been in a restaurant where you're having a very pleasant meal, nice conversation, and you're not quite done. You're saving the last couple of morsels of a delicious meal, and then the waiter or waitress comes by, takes away your plate. That's really annoying. Well, that's what we're talking about with risk management. It's not just taking the punch bowl away, it's taking your dinner away. And it's really hard to do that, never mind the legal challenges to being able to do that. And so in order for us to engage in those kinds of operations, we need to be able to motivate that by saying it's painful now, but the motivation is you're going to be able to avoid even greater pain in the future. So we need a new and more compelling narrative. That's the term that was mentioned a couple of times by the speakers in the session. Narrative. We need a new narrative. It's not enough to show a bunch of numbers. We need to say that if we don't do this now, we are going to be in a much larger world of hurt in the future. And that's really the role of systemic risk measures. That's one of the reasons why it's so critical for us to come up with new ways of gauging where we are, where we've been, and where we might likely be if we don't engage in that kind of policy intervention. So I want you to keep that in the back of your mind as we talk about the various different kinds of things that the speakers have mentioned in terms of their risks, and ask yourself, are those measures going to help us with that new narrative? So that's one of the motivations for the whole research effort on systemic risk here at the GCFP, is to really come up with as many new narratives as we can. And that's one of the reasons why academia plays such an important role in collaborating with both industry and government. You really need to have three legs of the stool in order to be able to build a solid foundation of this new narrative. And the way that I look at it is very much along the lines of the National Weather Service. The National Weather Service plays an incredibly important role to all sorts of stakeholders, but in particular farmers, because they need to figure out how to manage their crops, when to harvest, when to plant. And if a hurricane is coming, they have to decide what to do at that point. It's not the job of farmers to forecast the weather for the entire country. It's not the job of the private sector to forecast systemic risk for everybody. They're certainly part of the system. They certainly have a lot of information. And we're going to be going to those of you in the private sector over the course of the next few months to try to get data from you to be able to put those pieces together. But ultimately, it requires a different approach, this National Weather Service approach. So that's one of the reasons why a number of us have tried to develop as many risk measures as we can. Let 1,000 flowers bloom. That was the motivation behind the survey paper that the OFR did at the very beginning, where we put together over 30 different measures, and we actually encoded them into MATLAB so that everybody could actually start playing with it and just getting a sense of how these measures do or do not work in various different contexts. And since then, there's been a number of papers that have been written on horse races comparing these measures. The Giglio, Kelly, and Pruitt paper, the Chicago Fed has a paper, the OFR Stability Monitor, of course the IMF, the Bank of England, Rob Engel's VLab, and our own dashboard for systemic risk that's going to be coming live soon, and what Sanjeev talked about during lunch. All of these are really meant to paint a different narrative at different points in time. And that's one of the reasons why I was so excited about the 3 papers. The 3 papers that you just heard provide us with some very different narratives that you can't get in any other way. And so I want to talk about each of those. Since I have limited amount of time, I've forced myself to limit my comments to 3 per paper. I've been told that 3 is the number of ideas that we can keep in our brains. So I'm going to try to do that. Let me start with the Hanley and Hoberg paper. This is a really fascinating study that's applying a technique that's relatively well known in computer science, but is virtually unheard of in economics and finance, text mining. And not just bag of words, not just calculating the number of times certain words occur, but trying to see certain kinds of patterns and aspects of those words that play into broader topics, topic modeling. Now, text mining is not new, obviously, and all of you, I think, are familiar with the fact that language is important and it changes over time. Just a few weeks ago, I heard my younger son, who was a teenager, talking to one of his friends, and they were talking about what they were going to wear to a particular event. And so my son was commenting on his friend's outfit and said, "Oh man, that's sick." And I thought that was really rude. It's pretty nasty. And then he said, no, sick is actually good. And I don't know when that became the case, but lexicons changed over time. So I decided to come up with our own example, which is just to do a word search of the US federal code, all the laws of the land. Just do a word search, frequency counts, the time that swap and leverage occurred in our US legal code. From 1925 back to 2014. Sorry, let's see if I can get this back. If you take a look at those 2 words, swap and leverage, you'll notice that at the very beginning, that virtually, it never occurs in our legal code. But around the 1970s, swap and leverage became much, much more popular. Not surprisingly, because those tools became part of our institutional landscape. On the other hand, if you take a look at the word distillery, distillery was very popular in the 1920s, 30s, and 40s, but shortly after Prohibition, it stopped being used. And so looking at words actually matters. And so what Hanley and Hoberg have done is to focus on risk disclosures in 10K forms, which I think is a brilliant idea. Words matter. And so I just have a few comments on what they've done, 3 comments. The first comment is, in order to give us a sense of how much they matter, I would have expected that these risk disclosures have become much more important after Sarbanes-Oxley than before. Because before, you could argue it's window dressing, who cares, no, it doesn't matter, and the CEO probably doesn't have to worry about it. But after Sarbanes-Oxley, the CEO and the CFO, they have to sign their names to these disclosures. So just doing a simple comparison of pre-2002 versus post-2002 and looking at the differences, that would actually give us more comfort that what you're finding is really genuine. I think it is, but I think you've got the data now to look at it. It would be worth doing. Second, in your paper, you talk about systematic versus idiosyncratic risk disclosures, which is a really important point. In other words, every individual firm is coming up with these various different topics that they're disclosing in their reports. And so what Hanley and Hoberg are doing are looking at the commonalities among these risk disclosures, the covariances, as it were. But I think that's still very much a standard finance econometrics framework. Forget about covariances, which are essentially linear measures. Why not use cluster analysis and ask the question, are you seeing clusters of risk disclosures? Because my sense is that what you're going to be getting is, for savings and loans, you will get certain kinds of risk disclosures. For community banks, you will get other kinds of risk disclosures. For much larger multinational banks, you'll get yet a third set. And instead of getting purely idiosyncratic or systematic kinds of risk, I think it's going to be a continuum. And by looking at the clusters of the clusters of the topics, you're going to actually see some really interesting risks develop, perhaps even sector by subsector within the banking industry. Last comment is that you're focusing specifically on risk, and understandably so, but you've got the resources to be much broader. In fact, in a minute, I'll talk a bit about that with the second paper. When you look at Sujit's paper and you think about overall sentiment, you can look at that as well in your 10K reports. You can look at overall sentiment. So why not do that? In particular, you can actually look at something that many people have started talking about, but none of us has really been able to get at, which is culture. You know, we often talk about certain banks having really strong culture, other banks having relatively weak and ineffective culture. You know, I dare say that one of the reasons that BlackRock is as strong a firm as it is because of the culture that was instilled at the very beginning, thanks to Ben and other colleagues. So that's something that's very difficult to measure, at least if you read the sociology and anthropology literature. But you guys can do that. You actually have the means of doing that. And if you can take a look at the banks that have failed and see whether or not you can detect any differences in their language to look at certain kinds of culture that aren't particularly conducive to financial stability, that would actually be incredibly useful. So now let me turn to Sujit's paper, which I found equally compelling and from very much along the same lines. Text mining for sentiment in these various different sources, I think, are incredibly insightful, particularly because these are generally qualitative measures that we talk about that we really don't have ways of capturing. And this notion of conviction narrative theory, the idea that you need to be excited by the particular opinions that you're engaged in, is very difficult to quantify, but they've managed to do that. So my 3 comments here are, number 1, you know, there are other measures of market sentiment that financial economists and practitioners have used. One simple example is the put-call ratio. I won't mention some of the technical analysis indicators because I realize that people would consider that voodoo finance, but that's definitely meant to measure this notion of strength and weakness. So I think that that's something that would be worth looking at to see whether or not the traditional measures of sentiment relate. You look at some like the VIX and the Consumer Finance or a Consumer Confidence Index, but there are others. The second comment has to do with the asymmetry of your Bank of England uncertainty indicator and your particular relative strength indicator. I think this is something that is so important that it should be brought out to the forefront instead of hidden in figure 10. So let me just really recapitulate what you said very briefly in your presentation. What you've pointed out is that it's not uncertainty that affects productivity, but rather the perception of uncertainty that affects realized uncertainty that affects ultimate productivity. Is that a fair statement? Well, I would propose that you actually look at the reverse of that, which is implied by your impulse response function. By that I mean the lack of anxiety produces the reverse of uncertainty and economic growth. What that means is that during periods of irrational exuberance, that's the time when the seeds of financial catastrophe are being planted and nurtured. And your indicator actually identifies that. So I would look at the opposite of the downside. I would look at the upside and use your indicator of entropy as well as your confidence to get at that. Last comment about your paper, and I'll turn to the last one, is your entropy measure tells us that in the 2007 and 2008, there was a lot of agreement, low entropy, high consensus. I'd be curious to know what that result was in the period before. You don't have this in your graph, but 1996 to 2004, because that period where it was a lot of consensus as well. Consensus the other way, like housing prices would never go down. And it would be equally useful if you could actually measure consensus, but in addition, add a measure of polarity, that is positive or negative consensus. If you could do that, you can start thinking about how to create these kinds of indicators to be used as part of counter-cyclical buffers. Imagine if you had a perfectly accurate indicator of that kind of a measure. That would allow us to create the equivalent of driverless cars. We could have supervisorless banks if we had that kind of a measure. Last paper by Co-Pierre and his colleague. I apologize for the misspelling. I took the name off the program. Co-Pierre and his co-author produces a fantastic data set, a network model of interbank loans from July 4th to October 30th of 2008. And they use a variety of linear regressions to relate measures of connectedness and importance to liquidity provision and access. So my 3 comments are this. First, given that what we care about is early warning signals, given that we want to take something to Nellie and to Ben to have them make a decision, we need to figure out how much early warning there is. I understand that his interest was in looking at what was going on during the credit crisis of 2008, but the seeds of the credit crisis didn't happen in 2008. In fact, here's the same LIBOR-OIS spread that Co-Pierre put up, but I'm going to give you a little bit of a dynamic version. This is what it was starting at the beginning of June of the summer of 2007. And here it goes. So if you are sitting on a trading desk during the summer of 2007, you did not go on vacation in August. In fact, this was the beginning of the quant meltdown, this extraordinary rise in the LIBOR-OIS spread. So I wonder, could you bring your data back to 2007 and share with us what happened then? In fact, you could actually tell us where the epicenter of the financial crisis occurred and trace it out starting in 2007 all the way up to the disastrous 2008. So this brings me to my second point, which is something that Co-Pierre already mentioned and apologized for. If you're going to write a paper about networks, you got to have a network graph. I'm sorry, but you have to. And even if you make it up, you have to have a graph. And that was my big disappointment. So since you don't have a graph, I'm going to put up my graph, the one that Sanjeev kindly referred to. But this is a little bit different than what Sanjeev showed. This is a graph of that very same Granger causality network, except in this case, this is joint work with Bob Merton, Dale Gray, and our other co-authors of the paper. We're using credit default swaps between sovereigns, insurance companies, and banks. And this is what the network looked like the day before the Brexit vote. And this is what the network looks like the day after the Brexit vote. Now, the reason that I put this up is because, as I said, we need to have a network graph. We're going to talk about networks. Co-Pierre, you actually have the ability to put together a network graph like this, but instead of using these indirect inferences of Granger causality, you've actually got the real data of loans. And so what you can do, if it's a choice between looking at this graph and looking at your graph, you win, hands down. And so if you want a narrative that actually can get Nellie or Ben to take action, what that graph is going to look like is not just something like this, where already we see points of concentration and exposure that would lend regulators to start asking more questions about those specific institutions. But what you can do with your data is to create a narrative. And that narrative is, day by day, you can actually trace out how a shock that hits one bank actually propagates in that network over time. Of all of the various indicators that I've seen, the one that I think will put Ben or Nellie over the edge in being able to actually engage in some kind of intervention is a dynamic network graph that shows a particular shock propagating and a few very large institutions, some of which are well connected, others of which are not connected, that are on the outskirts of that graph, and say, if you don't do something now, you're looking at a world of hurt in the next few weeks. So I would encourage you to do that. You don't have to put labels on it. You can just show us with completely unlabeled nodes what that looks like over time. That would be extraordinarily powerful. So let me conclude by saying that we know that financial markets are highly dynamic and that risks vary over time, circumstances, and strategies, so that financial stability is also going to be dynamic. And as a result, we need to adapt to these kinds of changes, and particularly changes in human behavior, even to the point of changing our risk measures because of the Lucas critique. Whatever risk measure we use, people will start to game it and react to it. Because you can't manage what you don't measure, you really need to create a number of different measures to paint that narrative. And I want to close with a completely unrelated description of why narrative is so important for oversight. The story has to do with an individual that some of you may have heard of, Aaron Lee Ralston, who was a hiker that got caught between a rock and a hard place in Blue John Canyon in 2003. His story was written up in this wonderful memoir that he put together, as well as in a movie called 127 Hours. The way he escaped that rock was by cutting off his arm slightly below the elbow. And the question is, how on earth did he do that? What an extraordinary feat of courage. And the answer is that he developed a new narrative. And he describes to us what that narrative is. And let me read to you what it says in the book. After being trapped for about a week with no food, no water, nowhere to go, he began hallucinating, and he had the following vision. A blonde 3-year-old boy in a red polo shirt comes running across a sunlit hardwood floor in what I somehow know is my future home. By the same intuitive perception, I know the boy is my own. I bend to scoop him into my left arm, using my handless right arm to balance him, and we laugh together as I swing him up to my shoulder. Then, with a shock, the vision blinks out. I'm back in the canyon, echoes of his joyful sounds resonating in my mind, creating a subconscious reassurance that somehow I will survive this entrapment, despite having already come to accept that I will die where I stand before help arrives. Now, I believe I will live. That belief, that boy, changes everything for me. The ironic thing is that in 2003, Aaron Lee Ralston was not married. He did not have a girlfriend. He had no son whatsoever. He wouldn't have gotten married until 6 years later. And ultimately, he did have a son, Leo, born in 2010. If you expect somebody to cut off their right arm for you, you need to give them a different narrative. And with the 3 papers that we have in the session and the work that we're doing here at the GCFP, we hope to be able to do that with your help. Thank you.
Texas Law School. I really like Kathleen and Gerard's paper. And in terms of the methodology, the paper basically assumes that, in terms of the methodology, the paper basically assumes that, in effect, the banks have discretion subject to SEC rules in terms of disclosure of prospective risks to decide what to talk about and so forth. But in fact, that kind of discretion is affected, and the words and clusters of words that will appear is affected in part by changes in the legal environment. So that, for instance, in terms of the so-called management's discussion and analysis requirements of the SEC, the core requirement in terms of forcing banks and other registrants to disclose risk, hey, in the wake of Enron, they changed the MD&A to cover more off-balance sheet liabilities. Or during the course of the global financial crisis of 2007, 2008, the SEC either formally or informally, such as through Dear CFO letters or interpretive guidances, said, hey, companies should disclose more about their exposure to mortgages, their exposure to European sovereign debt. So that is that some of those kinds of words or clusters of words appearing and how they handle, in a sense, is affected by changes in effect in terms of what the SEC requires. And then on top of that, in terms of related to the legal environment, is sometimes these things appear in litigation. And of course, banks and others have to disclose lots about their material litigation. So again, those things might affect kind of the analysis. But again, I thought it was a wonderful paper.
So can I answer the question? I think that's a really important question. We thought about this one a lot. And underlying the question is really, is it the changes in the law governing 10Ks that's changing our covariance results, which is not as interesting? Or can we really actually show that it's something coming from the covariance? And there's 2 observations where I think I've convinced myself, I want to hear your opinion, that it's really not the changes in the legal system in the 10K that's driving the results. For example, if I lag the 10Ks by a year and rerun the regression, the results don't change much. 2, we recalculate the covariance matrix every quarter, and we only have 10Ks every year. What I'm saying is a lot of the growth in the R squared is occurring during the quarters when we actually have no updating at all of the 10K, meaning that it's really the trading activity and how that's changing that's generating most of the results?
Well, there are certain requirements that basically kick in when there are material enough changes, even before the next issuance of the 10K, where the companies do have to make disclosures, right? So there are interim requirements that kick in. And in terms of the idea that it just wouldn't be influenced, well, gosh, if you look at, in addition to what Andrew referred to in terms of CEO, CFO certification in the 2000 era, those requirements, if you compare just impressionistically, of course, I didn't do the sophisticated textual analysis, they read differently in terms of the kinds of risks and they discussed and how deeply they discussed them, how thoughtfully, as opposed to boilerplate. That you have to, in effect, separate out the boilerplate disclosure from the truly informative disclosure that the SEC is with cyclicality, enforces or non-enforces to provide real information rather than just boilerplate protective disclosure about risks.
This is a question for Andy, but it could apply really to any of the network papers we had, which is, if just eyeballing your Brexit charts, your Brexit networks, it looked like maybe 20% of the major nodes post-Brexit didn't exist. They were like in rural areas, if you will, before. So there's this problem in network analysis of extreme discontinuity. So in a crisis, it may be that our network looks fundamentally different from the way we thought it looked just a moment before. How should we think about that problem?
So you're exactly right that there are these kind of discontinuities. And that's actually one thing that I wanted to emphasize, but didn't get a chance to. You'll notice that in a number of the papers, both this afternoon and this morning, the traditional tools of analysis are linear regression. Well, the fact is that systemic risk, almost by definition, is not linear. Linear regression tends to work best for relatively small perturbations where things are really linear. A systemic shock is generally not going to be linear. And the reason that you've seen network analysis with so many different papers is because we're finally realizing that the way stuff happens is actually not linear. It's that one bank fails over here, and then for whatever reason, another bank completely on the opposite side of the spectrum of business or geography starts to fail. And so I think that rather than being a problem, I think it's a feature. It's a feature, not a bug, in the sense that these networks, they can change really dramatically, which is one of the reasons why using linear measures like VAR, stress tests, or standard measures of statistical significance really don't get at the same kind of issues. You need a different mindset, a different framework, and the three papers in the session really get at that framework.
This is the question for Sujit. Sorry, the second paper. So something like your sentiment, early warning signals, it's elevated, but stays elevated potentially for quite some long time. So in these situations, it will be hard to maybe implement like a counter-cyclical measure. Did you look around like tipping points, or what could you extract information, with some kind of a second order acceleration, or, or changes in cross-sectional patterns, or, correlations, because that potentially could be then a tool to actually implement some of those.
So I guess my perspective is you see the measures elevate, so 2004, 2005, in terms of showing very high sentiment. You probably want to, in practice, look at that alongside other indicators. So I mentioned we'd think about this as one in a spectrum. So things like the credit to GDP gap, what's happening to asset prices, and so on. I think if a picture emerges that you have lots of signals from different sorts of sources coming at a similar time, then you can take preemptive action. So just with respect to this measure, I guess it's quite hard to decompose and identify exactly. I mean, we've got some structural break tests in there, but that's a backward-looking phenomena. In some ways, I think the consensus measure is trying to get a little bit at, does this seem pretty persistent and consensual in terms of what is going on? But I think you always want to supplement this with other information. But I think one of the advantages of this sort of thing compared to some of the other measures is some systemic risk measures show very well contemporaneously, but when it's contemporaneous, it's almost too late. You want to see the signal well in advance.
I think it's a very good point. But what I'm trying to say that actually you could take this analysis one step further, use exactly the same information that you have, and then look at the second, third order degree of effects. You can build on this. It's true you can use other information, but I think you can actually just continue in this pattern, with this data and potentially extract further.
Yeah, I think in that sense that would.
And this is kind of a common method that seems to be used in like early warnings type of system analysis.
Yeah, I think that makes a lot of sense.
Thank you. Very interesting. In terms of the result that the correlation of the risk disclosures has gone up over time, do you have any sense of whether that could be due to something that's happening more on the legal and the disclosure side as opposed to the actual risk-taking side? So I know when you read many hedge fund prospecti, the lawyers will draft the prospectus such that they can hold anything. Like you might be reading the prospecti for a fund that only trades futures, and then when you look at the risks, it's like, well, they could hold private debt, they could hold mortgages, and it's sort of unrelated potentially to what they're doing. So, is that a risk in the analysis?
You wanna?
Well, if you get a lot of boilerplate, then we won't see, that the differential covariance among different firms will not be picked up, right? It'll just sort of be like a foundation for everything that we see. And so a lot of what we also try to do is do a cross-sectional analysis, right? So if we're picking up boilerplate where the SEC says everybody has to have a certain level of disclosure, we wouldn't find anything then when we looked at different banks. But what we're seeing is a lot of heterogeneity in the exposure of certain banks to certain risk discussion. And to go to Henry's point, it's a good thing that the SEC requires them to talk more about certain stuff. But it also presupposes they know what stuff they should be talking about, all right? So what we're trying to see is whether or not banks in crowdsourcing that information in advance of maybe even the regulator knowing that this should be talked about in more detail is whether it's starting to bubble up a little bit more. So one thing we could look a little more closely at is when does the Dear CFO letters come out, and is it maybe later than what we're picking up as banks voluntarily disclosing that information?
I guess one also for Kathleen and Gerard. In some sense, I like the textual analysis, but it does only get at understood risks perceived by both participants and then perceived by the market, because it has to show up in covariances. And in some sense, the analysis is a little bit ex post, and it doesn't actually include some of the big exposures that I would have liked to see, because you don't see synthetic CDO squared in there. You're just looking at mortgage exposure, and you're not looking at wholesale funding, which I think of as actually the major systemic risk that came home to roost, was reliance on short-term wholesale funding. And I don't know if you run that textual analysis, is it appearing in disclosures and is it appearing in covariances well beforehand? And so my guess is the answer might be no. And I like the method, but it does seem to be very limited to the idea, the risks that the market already understands and that people already are disclosing.
So I think this is a really central question. I think there's a good answer to it, but it entails quite a bit more work. So we are running the analysis just on the risk factor section of the 10K. There's no question that we cannot detect a risk that's not discussed in the risk factor section of the 10K. However, two things. One is, we found 18 factors. Those are, in a sense, the most prevalent. In the paper, we actually do document an exercise where we show, hey, you can drill down, because a semantic analysis allows you to do that. The exercise we take is we have marketable security risk as one of the 18 risks, and we say, okay, suppose a regulator saw that, they might want to know which marketable securities. So we reran the semantic analysis now in commercial paper, mortgage-backed securities. And so you can drill down, but the information has to be in the 10K. That's one answer. But the second answer is that there's no reason why you cannot increase the corpus to include other documents that could be the type of document that only the regulator has, for example. They can run it in-house if they have a lot of information on that. Or one can include even stuff from the media. And it's meant to be dynamic. It'll bring to your attention factors, even if you didn't hypothesize them there.
I'm not meaning to undermine. I'm just saying it is limited to what that can happen. Can I go on and make a question of the paper?
Yeah.
banks might pick up stuff earlier than others, and you will see, some of them ahead of the curve, and then the rest of them follow us.
Absolutely.
And Sujit, just on your measure, it does, I guess I'd be curious how you are thinking of using this, because in framing it as Andrew did about narratives, if people get excited and they think things are going to be good, or they get anxious and they think things are going to be bad, that could be demonstrating some real anxieties that are coming out there, or they could be real great opportunities that are out there. I don't see that as a basis for narrative for telling people they're wrong.
No, I mean, that's ultimately a judgment. I mean, I guess what you're picking up in the measure, arguably, is some over-exuberance. And now the question is whether that exuberance is a problem or not, let's say. But I think identifying exuberance is a start to be able to think about whether you want to take action. It allows you to probe further, to actually look at whether that exuberance is justified or not. So you could say, okay, you're picking up a new paradigm. So go back to 2003, people would say there's a new economy, the debate about diversification, risk sharing, and so on, and that's all. So therefore, this time is different. I guess what these measures can show caution against is, okay, that is going on. If you want to make a judgment that this time it genuinely is different, that is fine. But I suppose if you look at other measures and you see exuberance emerging in credit, in asset prices, and so on, then maybe you should be a bit more cautious. I guess I'd think about complementing this with the sort of work that Alan Taylor has done to look at credit booms and crunches throughout history.
Yeah, so Nellie, you were very kind to serve as moderator for the session, but in fact, I think you should have been the discussion, because I think that the audience is more interested in your comments than mine. So would you mind just sharing with us a little bit about your thoughts on the papers, the systemic risk, and so on?
Well, so maybe I can say a couple things in responding to your question about maybe challenges of macroprudential policymaking. And Sujit addresses these things at the Bank of England and at ECB, so these are common issues across many of the central banks. And I'll kind of get to where networks happen. So macroprudential policymaking is easy when it's totally in sync with what is good microprudential. If keeping a bank safe and sound is also the exact same thing as keeping the system safe, that's all easy, and there are very few questions that get raised. I think it starts getting more difficult when they might have conflicting objectives. And I'll use maybe stress tests as an example of, that's one of probably the Fed's major macroprudential tools. And you'll see it's fairly modestly implemented at first, but over time has the potential to do a little bit more, especially, say, with networks. So we've started pretty modestly. I think with stress tests, we would say it's a major tool. There are a couple macroprudential elements in the way it is implemented now. One is there's a scenario that is designed for the stress test that the banks have to use. Currently, it's designed to have a bit of tries to mitigate pro-cyclicality. So when times are really good, VIX is low, economy's been growing, corporate profits are high, and everyone thinks good times will continue forever, we try to sort of increase the severity. And there's sort of a rule in the policy statement about how we design those scenarios. At the same time, then, when you're at very high levels of unemployment, you try to reduce sort of the additional severity that you put on. So that's one element. I think it's been successful. The stress test has been about 5 years, and it's moving that way, but we're learning as we go. So that's one element. The other macroprudential element, two of them, I guess. One is all banks are subject to it at the same time, so you get a sense of common exposures. Like, not every bank can not have real estate losses. So if you do one bank at a time, they're always better than average. But if you do them all at the same time, you can kind of get a better sense of what is in reality. The other piece is that banks can't shrink to health, so to speak. You can't, but to meet your capital requirements, you can't shrink your loan books, because that will just cause the economy to contract. So those are sort of the way we've been doing it. We have a more ambitious agenda, and Governor Trullo gave a speech earlier this week, actually, which laid out some elements of a 5-year review that we've just undertaken of the stress test. One element is how do you get to be a little bit more macroprudential? And this is really where the challenges of macroprudential policymaking come up and is really evident in the networks. When you look at this network stuff, you can see one bank can kind of control its very local network, but can't control everything else out there. And so in making policy, for example, would you make a bank hold more capital because there's a weak bank out there in the system? And network and true macroprudential would say yes, because that weak link, the system's only as strong as the whole thing. But you have to, as researchers and academics and policymakers and everything, you have to sort of be able to, that's a policy, very difficult policy decision to tell an institution that for the sake of the system, they have to hold more capital. Not because they aren't safe and sound, but because they need to hold it because there's other institutions in the system that might not be. And so that's where the challenges are. I think network analysis will be able to help us. We've done work on looking at the largest counterparties under stress. What you find very quickly is that we might know what that is, but no individual institution knows it. So how do you ask them to capitalize for something that they really are not in a position to actually observe? And so network analysis might help because you might be able to show these pictures without identities even. It just might, but that's like a goal of trying to further develop these things. So. Are there any more questions for the authors? Do you have a few more, just one, anything else? Okay, so thank you very much.